Adobe reported earnings after hours. The stock is down 4% pre-market. How bad was the earnings and what prices should you buy Adobe? Hello fellow investors. Last time I screened Adobe, it was at 452.13. I told you it's overvalued, don't buy. If you didn't, I saved you $87.05 per share. Now that it's trading at 365.08. We'll be screening Adobe again with our new and improved metrics, but first we'll look into their earnings report. This is Adobe's earnings snapshot. Revenues are up 14.37%. Net income increased by 5.56%. Free cash flow increased by 1.11%. EPS increased from 2.32 to 2.49. Basically, Adobe beat both base and analysts' expectations. Everything here looks good for Adobe, but their margins are slightly lower. Profit margins decreased from 29.1 down to 26.86. Free cash flow margins decreased from 49.36% down to 43.64%. Now guys, yes, their margins decreased, but the value of the net income and free cash flow increased, which is more important. And that's why we always assume the lowest margins to be our entry PEs and our second metric, because these margins fluctuate. Now, why is the stock down? They said it's because of lower guidance. I say that's bull and don't sell Adobe because of that. Again, I don't believe in projections unless they themselves declared that they'd be spending and their margins would contract. But projections are just random numbers into the future and no one knows the future. Now that we've established Adobe's earnings were actually good, let's look at Adobe on our updated metrics to see how much we should buy Adobe. This is Adobe's valuation summary. This is updated to their recently released earnings statements. If you're a returning viewer, you must know these numbers by now. If you're new to the channel, I'll explain these numbers later. Adobe is currently trading around fair values based on my second metric. The lowest margin I used here is 34.18 multiplied by the EPS trailing 12 months of 10.24. Fair value is 350. Intrinsic value here is from Guru Focus, $155.26. I kind of understand this. It's because of the PB ratio. It's too high, 12.33, but I get it for Adobe. It's a growing company, and these metrics could lag behind. So I'm not entirely worried about this. They just need to keep growing so these metrics would catch up to their valuations. I have here my entry PEs and prices, 30% margin of safety, the usual. Highest price is $328. I might start a position there possibly, but it depends. I don't own the stock yet. I think paying premium is reasonable. I have a rating of hold here. Let's look more into Adobe. Adobe is down 48% of the highs, no dividends. EPS multiple is greater than 3 at 3.58. I normally use my first metric to screen stocks. I believe in paying only 3 times their EPS. PE here is what we're really paying for in stock. Normally, I'd avoid this, but the PE is actually reasonable because Adobe has such high margins. EPS is increasing, good. OSN is decreasing, good. They bought back 18 million shares in 5 years. Second metric, I pay $1 or less for 1% of the money they're making. This is based on the lowest margin between the net income and free cash flow margins of this 4 time frame here. The current or previous year, the trailing 12 months, and the 5 and the 10-year average margins. You can see here the difference in profit margins and the free cash flow margins. Use the latter because it's more important. I use the lowest margin of 34.18 here, the 10-year average margins, to divide the current PE and to base our fair value from. 1.06 is the premium we're paying if we buy Adobe at these prices, and this is why I think Adobe is trading around fair values. I have a discount here of 30%, their highest margin as safety of margin, the normal 30%. This would then make my PE assumptions. I could be buying Adobe from 28, 30, 32 PEs. I said paying premium for Adobe is reasonable. Here's why. Look at their revenue growth. 20% yearly growth. That deserves a growth multiple, not to mention a mode multiple, because Adobe is a premium photo editing software. It's like the go-to software and possibly the leader in the space, if not a monopoly or duopoly or some. Third metric is price to free cash flow to PE. We want to pay a lesser PE than their price to free cash flow. Anything beyond 20 price to free cash flow, I won't buy. That's my allowable price to free cash flow. No fourth metric, since Adobe is not paying dividends. Last metric is historical data. PE and price of free cash flow wise, it's trading at a discount, but it's important to look closely at these numbers. Average PE is low to mid 50s. I don't think it should trade at those PEs. I think it should trade at high 30s to mid 40s. Price of free cash flow, I have an allowable of 20, so beyond that, I'm not buying. Same with PB ratio, I have an allowable of 5, but I understand that it's trading way above. I said it before, Adobe is still growing, and these metrics could lag. Here's more financial information for Adobe. PB ratio is high, 12.33. I want this below 5. Current ratio is strong for the quarter, 1.07. They're essentially debtless thanks to their strong cash flow and strong cash position. Again, here is Adobe's valuation summary. These are all connected. Let's confirm my fair value of 350 and my high entry price of 328 on their charts. I think these prices are feasible given the market situation right now. Again, 350 is fair values. 328 is my high entry price. There's a gap at 320 here. Maybe we'll get to close that. Then there's another one below 300. I'd only recommend buying Adobe at these prices, this range here, this rectangle. I'd put an alert on Adobe if I were you. I think it's a great stock to hold for long term.